please welcome Peter Csathy, the chairman of Creative Media, to moderate Acquire or Be Acquired, Navigating the Complexities of M&A.
Now for something completely different, buying and selling companies in the media and entertainment space. And again, we have another great panel. And when we put this one together, wanted to get participants across the spectrum, like the buyers and sellers and the money. And so first, I'm going to welcome to the stage Stephanie Horbaczewski, who has been a seller, but she's the true entrepreneur. She had a nice 9-figure exit, and I'll do the math for you. That means at least 100, and how far that goes, I don't know. But so Stephanie Horbaczewski.
Hi, nice to see you.
By the way, CEO of a company called Vody now.
Yes.
All right. And then welcome to the stage Olivier Chastan, who's the founder and CEO of Iconoclast, which is a buyer and also a branding marketing firm in the music space. So music catalogs, music IP. Olivier. Next, we're going to have Jason Sklar of Shamrock, private equity firm. I've known Jason for a long time as well, so welcome, Jason. Ethan Sawyer from Guggenheim, also somebody who I've known for quite some time, but Guggenheim is another great firm. Investment banker. And then finally, we have Charles Johnson here from, sorry, I did it again. Ed King from BTIG, and I've known Ed for a while now too, another great banker. And then CJ, Charles Johnson here from Truist, another investment banker who's focused on the media and entertainment space. All right, we all agreed that we're going to dispense with introductions because we have a really limited time on this one and there's a lot of ground to cover. So I'm going to get right into it with overall market conditions and want you to all comment on how that is impacting what you see out there in the marketplace and the opportunities, both as a buyer. We'll talk about your experience a little bit after that, but also for what you do as bankers. So, we have the writers strike and the SAG strikes, global financial conditions, of course, with the markets. We have the business models we talked about, streaming completely disrupting Hollywood and what's going on there, antitrust, technology that we just discussed, AI. So these are just some of the massive forces that are impacting everything these days. So let's ask, I'm going to open it up. How is that impacting M&A in the media and entertainment space? Because things seem to have been slower than they have been for the past several years. So what is it like right now, and what opportunities are you seeing? CJ, I'll start with you.
Yeah, you did tell me you were going to start with me last night, and I was hoping you were joking. You put it this way, the three of us are all compensated based on our deal volume. And so I think if you added our collective bonuses up for what we're going to get paid this upcoming year, it will be the same as what each of us got paid in 21. So that's a long-winded way of saying it's been slow. It has been extremely slow. And I would say that a lot of that is a function of just the overall market conditions. Being involved in M&A, and I also do a lot of capital raising, both on the debt and equity side. The markets have been challenging in terms of raising the capital to consummate transactions. The rise in interest rates has had an impact on valuations, and so the buyers have had, and I'll let Jason and Olivier speak to that, but the buyers have had a little bit of an issue trying to meet sellers' expectations and still get their return that that they've promised their investors. So all in all, it's been kind of slow. You factor in what's happening in broader media and entertainment on top of that, the challenges that the large media companies have been facing, the strike notwithstanding, but just the things that they've been facing with respect to their business models. And, I think we're in a period of discovery, and the discovery is going to reveal, sort of what's next, and what next may be a new business model, a new strategy, but I think it's all going to pivot to what we think is going to be increased activity next year. Because I think, look, I don't know the interest rates are going to come down anytime soon, but I think they're going to stabilize to a point where investors and buyers can look at the market and say, okay, I now know what my cost of capital is going to be, or I can triangulate it a little bit better before, when we were dealing with constantly,
Yeah.
the Fed constantly increasing rates. So we think it's going to improve next year. And, that's kind of our high-level view.
Ed, is that kind of your crystal ball too? And are you seeing that in this kind of pain, market pain, that opportunities present themselves because of that pain?
Well, we've been saying the market should recover 2 quarters from now for the last 4 or 5 quarters, I would say, right? And I think we all been sober in the fact that it has not recovered as quickly as we had originally hoped. So you look at global M&A volumes this year to date, down about 50% announced M&A volume globally. I think in the media entertainment space, about down 68% or so. So
Wow.
It's definitively a challenging environment. Whether or not it recovers next year or not to previous levels remains to be seen. I think it's going to take some time. But what we do see, though, is that buyer and sellers' valuation gap has narrowed. Not quite completely narrowed to the same point, it has narrowed. Like when sellers looking to either raise capital or sell themselves back in, let's say, early 22 timeframe, they were still looking at 21 valuations. And by then, the Fed was already increasing interest rates, and buyers and investors saying those valuations are out of whack. We're no way are we paying that. Now, as a result of that, there's been very little deal volume because the gap was too wide. That gap has narrowed, and we're seeing more conversation and dialogue between investors and sellers right now, and capital raisers. So hopefully that gap will continue to narrow going forward, and with that, hopefully deal volume should increase.
Okay, and I want to just complete from a banker perspective, Ethan. What opportunities do you see, if any, do you see the markets opening up because of these forces, like opportunities that otherwise wouldn't present themselves? Is there an area that you believe is of special interest out there in the marketplace?
Well, candidly, I spend an increasing amount of my time on liability management and thinking about restructuring.
Yeah.
All the issues you raised are real. I mean, the macro environment is tough. High interest rates, a regulatory environment which is uncertain. So even if you have confidence that your deal makes strategic sense and should pass antitrust muster, you look at some of the deals that are being held up, and it still may take you a year or two to get it done. So you have to kind of factor that in to whether or not the deal long term is going to make sense in an environment that is so dynamic and changing so quickly. I like to say that M&A is a tactic, not a strategy. And so I think that the strategic choices that companies are making right now they're so fundamental to their businesses. And M&A, they realize it's an important potential tool for them to use. But some of the choices around, and by the way, I think what we've seen with the strikes in the media space is it captures so much of the issue, right? Because when you think about it, when the strike started, it was really about how do we deal with this massive disruption that has come upon us on the distribution side? And literally right as it was starting, it added this really complex layer, which in many ways is even more complex, which is there's clearly an upcoming disruption on the production side from all the artificial intelligence issues that we've been chatting about over the course of the day. And so when you have that level of uncertainty, people really want to think through what's the right strategic decision for me, but actually acting upon it oftentimes becomes difficult to do something inorganic for your business, right? So the general sentiment is, let me kind of fix my own house and do anything I can in that regard. I'll make a note that I completely agree with Ed's point that I think the valuation gap has compressed. One of the issues there, though, is a lot of the thinking around M&A, at least that I'm seeing from larger corporate clients, is around how do I sort of figure out what's truly core to my business and streamline what's really important, and are there ways to sell or divest assets or maybe reposition some assets so that my business is more streamlined. But part of what they're finding is if you enter a phase like this where you already have a lot of leverage, you may find a buyer where you somewhat agree on price, but if that price isn't high enough to delever your business, then the transaction won't functionally do what you were hoping it would do in any event. So we're seeing a lot of tension around a lot of those issues, I'd say.
Yeah, and I want to get the perspective of you as an entrepreneur and the buyers out there, but I mentioned antitrust, and all the large tech-forward media companies, Apple, Amazon, Google, who am I missing? Meta, I think, but all of them have been involved in litigation of some kind with the feds. And so chilling effect on their typical acquisitions, but then you see what happened with Microsoft and Activision. So Microsoft acquired or made the deal to acquire, but that was blocked by the SEC, right? Or FTC? Yeah. So, but now that deal's going through. Is that correct?
That's expected to be correct, but it took a really long time, and it wasn't just the U.S. The U.S. issue. It was also the U.K. and Europe.
Yeah.
So they had, and if you look at it from a traditional antitrust perspective, arguably that deal should have really been no problem, right? So I think a lot of people are sort of saying it feels like the approach from an antitrust perspective right now is it's different than it's been historically. They're willing to look very closely at transactions that and take it from a different, almost more European type lens when they look at transactions. And I think that uncertainty, and Microsoft actually, it's a great case in point where, yes, it'll go through, but that's a multi-trillion-dollar company that has a huge amount of cash, can afford to wait, and that transaction has just taken, much, much longer than most people expected to go through.
Do you think the fact that if it does beat back that antitrust action, do you think that is a data point for the other large companies that are involved in that sort of efforts, and that will free them up in their own minds to go for additional M&A, or do you think that's not the case?
I don't think companies necessarily pursue acquisitions with an antitrust lens always on. I think it's a byproduct trying to get a deal done. And also antitrust sort of regimes vary administration to administration. This current one is probably more strict than the last one. So if you want to do a deal, maybe the next administration will be a little bit more lax and get it done then. So I think it's a and there's ways to structure around it, right? If you could just sell some assets, et cetera, you could probably perhaps structure around it. So I still think that antitrust issues is a factor, but not the driving factor necessarily, whether a company pursues or not pursue an acquisition.
And Jason, where are you now, given everything that we were talking about in terms of market conditions, and as a buyer, where are you seeing areas of opportunity for you, or just focus for you?
Yeah, and I think that today, so far, we've been talking about more traditional corporate M&A, right? And so we also focus on with private equity strategy, which focuses on corporate M&A, but we also have a content strategy, which invests in all different forms of content, whether it's film, television, music, video games, sports. And I'll tell you that it's been highly active in the past few years. During this period of disruption or uncertainty where volumes are down, there's more of a cautious approach. I would say bringing alternative sources of capital into the mix with those entities has led to a robust marketplace for us to tap into. Because I will tell you, as we all know, that creating content is an asset-heavy business profile, right? It takes substantial investment. And so to make that investment, you're always thinking about how best to capitalize yourself to do that, whether you're an independent party, whether if you're a corporate, but you might not have the scale of some of the folks that we're talking about here. And so we'd tell you that it's been highly active for us as we've engaged in those marketplaces.
Is there any area in particular that are, without exposing trade secrets, but that are of particular interest to your firm right now?
Yeah, I think we really move towards what's the highest quality of the content, right? It's subjective, right? How do you determine quality? It's commerciality. It's what do you think is going to have sustainability and longevity for generations to come. So when we think across film, television, music, games, sports, we're going to weave into all those 5 pillars and say, where are we going to find the best opportunity to invest in the content that we think cuts through all the clutter that comes at us day in, day out.
Yeah, content ownership, IP ownership. And Olivier, that gets into, on the music side, your business. So we were talking just briefly about market conditions for your business, and how does that impact? First, explain to everybody a little bit about what your company does and how you approach opportunities and what you see because of the market conditions we were talking about.
Yeah, I mean, we basically buy music rights, broadly speaking. So it includes publishing, sound recordings, but also what we call name, image, and likeness, which are the brand rights of the artist, which is really a tool that we use to further develop the catalog and their legacy and find marketing opportunities. Now, to answer your question, what we're seeing this year is a much quieter market. There are still a lot of deals, but they're very different than 2022, let's say. 2022, you had a plethora of really large deals, 100 million plus, 200 million, 500 million. I mean, it was just nonstop.
These were like the Springsteen deals.
And more. I mean,
Yeah.
you had a middle market that was really considered to be 100 million plus nearly. And so this year, there were probably around maybe 5 to 6 deals that were above $30 million. And the rest of the market were really smaller opportunities, which we never disregarded. So for me, there was not a huge change in that. If you look at 2022, our smallest deal was 1.2 million, our largest was 110 million. So we were really dabbling in both markets, so it was easy to pivot. The main thing that I think is the byproduct of the change in the marketplace, for me at least, is weaving out and pushing out a lot of our competitors. I hate to say it this way, but there were a lot of funds, a lot of people who have put money at work in music. And so what we're starting to see is either people exiting, trying to sell, some potential consolidation opportunities, and provide a smaller base of buyer within the markets. The other thing that's happening, which CJ touched upon, is, Ed, was that compression, the seller's expectations, and those are artists. I mean, we got to remember who we're talking about. And the artists tend to be like a freight train. They just have heard 25 to 30 for 5 years, and they'll continue
For
until
multiples of their earnings.
Right, of earnings, and they'll continue until they hit a brick wall and then suddenly start adjusting. Well, that adjustment took roughly 6 to 8 months. But at least I'm starting, I don't know about you, Jason, but I'm starting to see that coming into play quite evidently.
And here's what I'd say, just to add on to that, which is, I think, tell me if you agree with this, Olivier. It goes back to CJ's point about interest rates. There was folks that entered the music marketplace with using leverage as a primary mechanism to generate financial returns, with the belief that the rates would be at a low level for a period of time.
Yeah.
When the rates, as we've seen, have hit a 22-year high and within a relatively short time frame, that forces you to readjust your business model. And as you readjust your business model, that might mean you pull back a little bit as you think about further investing into a particular sector.
Right.
And maybe you think about generating liquidity for your shareholders.
Yeah.
Right. Yeah.
And Stephanie, I want to get to you as the entrepreneur. You've been through big ticket M&A yourself on the seller side. First, tell us about that experience and what the factors were at play ultimately in selling to RTL. Was it ultimately just the price tag, or did other factors come into play? And then I'd love to hear some thoughts you have, because you shared them on LinkedIn a little bit, in the technology side of media and where you think that there's some places that are ripe for M&A.
Yeah, definitely. It wasn't just price. It was deal structure. So one of the buyers wanted to make me very wealthy, and one of the buyers wanted to make my investors very wealthy. And I wanted to be an entrepreneur again, so we went with the one that made money for my whole team and my investors. So that was really the biggest driver for me, actually, between the two of them. And I wanted to keep running the company, and I did for another 4 years. So I went where I think I belonged at the end of the day.
What company?
Style Hall. It was one of the YouTube MCNs.
Oh, yeah.
Yes, sorry. I sold Style Hall, one of the YouTube MCNs, to RTL Group instead of Amazon for that reason. And now,
So you heard it here. So Amazon was in the running.
yeah, I guess that's the first time I said that.
Breaking news.
And on a stage to other people I have. Now I work in AI, and I'm really interested. The AI space has FOMO meets really high growth startups right now. So you're about to see a wave of acquisitions across that space. And I did write a post on LinkedIn, you can read, with more detail, but I put them into 2 buckets. There's buy to compete. So I'll give you an example there. I think that NVIDIA will likely buy CoreWeave and its explosive growth because their biggest customers are investing in making chips. And so it makes sense that they would back and start investing in cloud and data strategies. And CoreWeave is, as I said, explosively growing. And that would make a nice fit for them to buy into competition. And then there'll be people that buy to defend. So, I mean, I think we'll see Meta buy Character AI, for example. And there's 5 more examples on my LinkedIn.
So go to her LinkedIn. Olivier, just going back to you for a second. When you're looking at opportunities out there, what are you looking for from a catalog perspective? Because it's not purely a financial play. Well, it's a financial play in terms of return.
Tell that to my investors.
But you also have an infrastructure to build.
Yeah. No, we're building also what you would consider a platform, a real company.
Yeah, marketing.
The primary driver is really, I mean, I hate to use it because it's been oversaid, but the sort of cultural relevance. And I mean, my entire life, or adult life, has been, in music. So my perspective tends to maybe be less financially driven, I would say, than others. But at the end of the day, it's really, do I feel that these copyright, this intellectual property will be able to translate, like Jason said, from generations to generations? And can we also help that? Meaning, is there enough material meat, if you wish, in terms of life story, in terms of narrative that we can pluck from that legacy and this artist? And legacy is a broad term. It can go from 1950s to the 90s. So it's a broad spectrum. But that's really what we're looking for, is a rich creative base that we can use and pluck from to create sort of bridges to new generations and reintroduce that cultural legacy into the general bloodstream, if you wish.
And starting from, and the reason why legacy artists are so interesting is because they have a track record of financial performance. And so it's almost like an annuity. Think of an annuity. And so if you could add, there are some buyers out there that it's purely a financial play, just purely a financial play. But then there are other buyers like Olivier and Jason, you too, where it's yes, it's financial, but it's also having the infrastructure to be able to open up more opportunities that drive revenues.
Beyonce's tour made as much money for our economy as the Olympics did for Beijing. Like, that's a staggering fact, right?
Yeah.
Think of what's invested in the Olympics and what the return is expected. And this one artist on this one turn just gave that same return ROI. I mean, that's amazing.
You don't have to watch curling, which is amazing.
Right.
Hey, I'm from Minnesota, so that's staying. Okay.
Sorry, Peter.
Okay, so let's, CJ, I want to get back to you. What is in the past, this year, a deal that was interesting to you in the M&A or in the M&E space? Did you see anything that was surprising or expected, or?
I mean, look, there are always going to be, surprises. I can't comment specifically on anything that I or my firm has been involved in, but I think it's safe to say that there has been some pretty interesting M&A in the entertainment space.
So as an example, like the agencies, there's been the Endeavor deal. Where
I think that's probably the most surprising deal, because I don't know that anyone saw that coming. I think what the market probably expected is, there was a private equity firm that had been invested in CAA. They've been invested for a period of time. And, any private equity firm, has an investment horizon. At some point, they want to exit. I think the surprise was who the buyer was, because there are still people trying to put together and trying to understand, how Gucci loafers go with signing, a new athlete. And, you can sit here and say, well, that makes a whole lot of sense. And there are...
When the CAA selling to Artemis.
Yes,
Right.
CAA selling to Artemis.
Yeah, which is the luxury mogul, Francois-Henri Pinault.
Francois-Henri Pinault.
Yeah, okay. Yeah.
So that was, I think that while CAA trading was not a surprise to me, I think the buyer was what was a surprise to me.
Was that surprising to any of the others on this panel? Ethan?
Absolutely.
Yeah?
No, I mean, I think that was...
Well, Ethan, were you surprised that they sold? Or
Or more the buyer?
No, I wasn't surprised that they sold.
Yeah.
I was probably more. I agree. I was probably more surprised than the buyer. I mean, the interesting thing about a business like that, just the nature of the business, right? Any business where the talent goes up and down in the elevators every day.
Yeah.
The way you think about structuring a deal and who's going to have an interest in that asset and how it's always fascinating to see. This one, I mean, my sense is in general the industry too thought it came a bit out of left field who the ultimate buyer was. Fascinating.
Yeah.
Yeah, Concord was very quiet for a long period of time. So I think that part, the fact that they're re-entering the market was surprising. Roundhill had been trying to sell a few times. I'm not going to say anything that's not confidential. And so we knew that they were trying to find a buyer. But I think what's going on with Concord, and I don't know, maybe you've got some intel as well, but it feels like they're shifting from a more traditional private equity model where you want to exit and sell to more of a yield kind of play. Like an insurance company would bring regular cash flows. So that seems to be the strategy, which means that size, which sometimes can be an impediment to exiting if you're too big, is less of a concern. And so they can go back and start buying. So that's just my 2 cents. I don't know, Jason, what...
Let's get into some fun stuff of rumors, speculation. Okay, let's get into some of that. Disney's been all over. You know, obviously, I think it's the markets are Disney's at 8-year, 9-year lows in terms of stock. You know, something like that, and it's all over that Bob Iger has talked about his linear channels and potentially ESPN and potentially something even bigger than that. And I don't know how much any of you can say or can't say, but I would
Absolutely
love for you,
nothing.
Well, that means there's something. That means there's something.
Well, here's what I say, Peter.
Yeah.
I think you asked the question, what was over the past year was the most surprising M&A situations to the panel.
Yeah.
I actually think it's going to be the year ahead.
Yeah,
It's gonna
well,
be really
yeah.
interesting, right?
I would
Where
love
you
to hear
think
it.
about, I mean, what I'd say is assets that were never for sale are now potentially for sale. Partnerships that would have never been considered in the past are probably now being considered. And I think it's going to be a very active universe over the next 12 to 24 months as there's this shifting landscape. And how do you want to make sure you're positioned appropriately over that horizon?
So what do you think about Disney? Crystal ball it.
I'd say I ask my banker friends, what do you think about Disney?
Can you conceive
My
of...
family had a great time at the theme park.
Yeah, there you go. Well
time.
said. Well played. Can you imagine a scenario where the entire Disney was acquired by somebody like an Apple? There aren't many that could do it.
I go back to a statement that was made on an earlier panel that was made at dinner last night, and I'll say it again. I think the entire business model for many media companies is being evaluated by the executive management and the board. And I think it's quite possible that the way companies are aligned and configured and structured today, they're going to be some of them are going to be very, very different. Some of them are going to be marginally different next year because, again, everyone that owns a linear channel is struggling with cord cutting. Everyone that owns a streaming platform is concerned about profitability. So all of these dynamics come into play as boards and senior management teams sit down and try to figure out, again, like I alluded to earlier, what's next. So, again, I'm not at liberty to kind of put company names in the crystal ball. I get in trouble for that. And to do so
Well,
in
I have to
environments
put
like
one
this.
more out there, though. Rupert Murdoch just stepped down as chairman of Fox News Corp.
Am I allowed to applaud in this audience? Or?
Yes. Feel free. Sharon, is it okay for me to say feel free? Okay, feel free.
Sharon's okay with that, right?
Yeah, I'm okay with that.
I'm just kidding.
Feel free. But so my prediction, I don't know if it's a prediction, but I certainly wouldn't surprise me if Elon Musk acquired Fox. He already has X. There's a certain symmetry of mindset. So that's something that I could absolutely anticipate out there. We'll check back in
I would
12
just make the
months.
observation, there's a lot of banks that are sitting on a lot of debt from the X or Twitter
Yeah.
Oh, there is
acquisition that
that.
are a little
But
bit
it's
of a
Elon.
hangover on that front.
But it's Elon. They also want to be in business with him. Or they did. Okay, so let's get into you were talking about the excitement is really going forward in the next 12 months. So what sectors of the entertainment business do you see activity really heating up? You mentioned some of the media companies, who are being challenged, like the Disneys potentially, challenged by the streaming. But where should we be anticipating deal making really accelerating? Ed.
I'll take a stab at it. I think you can see some consolidation in the technology and business service sectors that support the entertainment ecosystem. There's a lot of duplicity in those two areas, and I think some consolidation is very likely to take place there.
Yeah, which kind of piggybacks on what you were saying too.
Yeah, we're going to see a wave in AI, that I know.
Yeah, when you have so many eyes that are focused on that. Ed, how about you? What do you see in your crystal ball?
I think we all talked about throughout the course today, there's some challenges with the entertainment business model, right? And when there's challenges with the business model, there's going to be restructuring, consolidation, et cetera. So I think that's where I foresee things happening, right? The other thing that we're seeing as a firm is the interest of capital from the Middle East in the entertainment media sector, right? Mm-hmm. So Live Golf Tour is one prime example. With oil prices increasing, right, these days, they're flush with cash, even more flush with cash. And they're trying to diversify themselves away from oil-based economy. So they targeted, or have identified, I guess, media and entertainment as one avenue for that diversification. So when we're talking with potential investors, when we're raising capital with for our clients, the Middle East has become increasingly more of a destination to seek capital these days, both from a direct fundraising standpoint as well as, I'm sure, capital raising for funds as LPs. So that could potentially increase over the next year or two.
So I would just make the observation that there's been a lot of disruption across business models and a lot of uncertainty in the overall macro environment we've chatted about. But I think that there continues to be, and if anything, in some ways, an increased focus on the value of the underlying content and IP. Sports would be a great example. I expect, to see continued activity in sports, broadly speaking. And I would also just note that, if you think about infrastructure players, and by that I mean the traditional pay TV providers, for example, or the large platform players, I think they increasingly understand that whether it's because of engagement or whether because one of the dominant use cases, consumer use cases for broadband or 5G is high quality video content that people want to consume. And I think we're going to start to see a reworking of that relationship. And I think, tough to say whether that's a next year, thing,
yeah.
But whether that means more partnerships or more finding ways for them to work together, because they're realizing that if you can't explain to your consumer, why do you need, 2 gig into your home, right? Well, the main reason for a lot of consumers is, well, I want to watch 4K, I want to watch sports, and we focus on the near-term disruption to the business models, but at the end of the day, right, what's really supporting all that is really high-quality content, whether that be sports, whether that be a movie. So
yeah, music. This gets back to what the two of you were talking about too, which is IP portfolios, ownership. So let's open it up. We have a very short period of time. Sharon.
And you brought up the question of the sea of oil money that has been fueling lots and lots of acquisitions anyway, Saudi Arabia in particular, Emirates, Dubai, all of those countries, though, Qatar. Is Fox being acquired with that money in majority ownership? Is that a possibility? Like, could Fox News be owned by?
I think that would trigger a lot of CFIUS review, because Saudi Arabia is definitively sovereign capital. Anytime there's sovereign capital, it triggers even more heightened CFIUS review. So if you see, for instance, TikTok, right? There's a lot of talk about TikTok and all the issues around TikTok.
But it's only talk. It's been 2 years and nothing has happened.
Right, but if TikTok were to buy, let's say, I don't know, pick a platform, that would definitively be blocked by CFIUS, right? Because they're deemed to be owned or influenced by the Chinese government.
Explain what that is to everybody.
What's that?
Well, but they could get a minority ownership?
They could possibly fund a buyer to help finance the acquisition. I can see that happening. Before, let's say the sovereign wealth fund of Saudi Arabia to buy Fox News entirely and have control over it, I think that would be very challenging.
Any other questions? Yes, sir. Please, if you could say your name and...
David Bloom, I'm just curious, who wants the linear legacy outlets, because it's probable, the consolidation you're talking about, the restructuring is coming, but who wants them besides Bayer and Allen throwing up a bargain rate for ABC, for instance? I mean, realistically, what's the spin-off, buy it out, do something? Is it just kind of a retake on what the newspaper business has been going through for 30 years for broadcast and local broadcast? I'm just curious where that goes.
Well, look, I'll just, I won't speak about specific companies, but I'll make the general observation that, and you can sort of see this from the recent Disney Charter deal, for example, that you're going to start seeing a convergence. It's distribution, but what's important is the underlying content, right? So it's channels, and then you have some ad-supported, streaming apps that'll be combined together. And so one of the key questions is with any of those, with a traditional linear channel, what's the underlying content associated with it? Yes, there's a question about how long those affiliate agreements will last and how much content you need to supply to support those agreements over time. And I think people are very focused on what's the right portfolio of assets you need in the linear side to basically position yourself for success in future negotiations. It's very clear, we can debate where the plateau will be, but we're continuing to see cord cutting. And I think the traditional question of, well, is it just a matter of finding a private equity player who's going to basically make a bet in terms of what that curve is and how long that'll be? It's a little bit different than that. The case in point for that would be, for example, what we've seen with the regional sports networks, right? We're trying to make that type of bet and then not factoring in that with this level of disruption, you really, there's a lot of uncertainty you have to factor into that, and your ability to kind of recut those deals moving forward. I mean, what Charter effectively said was this is the, we're stopping this game of just spending more and more for a product that fewer and fewer people are actually want. So in terms of who has interest in them, this is kind of gets back to my initial point about where I expect some of the activity we'll see, which is I think you're going to see, whether it's through partnerships or recut commercial deals or just a sort of a detente between the traditional distributors who as everybody knows, if you call right now and cancel your traditional cable service, a few years ago they would argue with you and they would offer you this, and now they say, great, but you're going to need a much faster broadband service now that you've canceled your. So that dynamic will continue to play out, and so I think it quickly becomes not a matter of like who's going to buy them, but rather how's everybody collectively going to deal with them.
All right, we are out of time, unfortunately, everybody, but I want to thank everybody who's been on the panel. Thank you all. You've been great. I wish we had more time so we can get into it. And if you have any questions, track these people down at the cocktail hour.